Weekly Market and Technical Analysis, November 28 to December 2, 2022. Market Analysis. The S&P 500 tumbled minus 1.5% Friday morning after the monthly employment report beat expectations. If this reflexive selling felt strange, you are not alone, and the stock market spent all Friday rallying back from those opening levels, erasing virtually all of them by the close. Apparently some investors still believe good is bad, but as we saw Friday, the majority of the market doesn't agree. Inflation is steering the Fed's interest rate policy decisions, and if the Fed can bring inflation down without crushing employment, all the better. This is the widely hoped for soft landing. Is it possible? Maybe, maybe not, but with inflation headed in the right direction while employment remains robust, that suggests this Goldilocks scenario is still possible. At this point, the market remains in a half-full mood, and that means it is not buying the bearish interpretation of November's better-than-expected employment. Until something changes, that means the path of least resistance remains higher. If this market wanted to go down, there have been more than enough excuses to send prices tumbling. The simple fact we remain near multi-month highs tells us the ground under our feet is solid, and Friday's rebound confirms it. Quite simply, if this market was truly fragile and vulnerable, it would have crashed by now. Sometimes the hardest thing to do is to stick with a winning trade when everyone around us is telling us why we are wrong. But since we trade the market, not opinion, this counterintuitive strength is far more important than what anyone else says. The simple fact prices keep going up when the crowd thinks it should be going down is our signal to stick with it. We will run out of buyers at some point, but this is not that point. Technical Analysis. Stocks closed mixed on Friday as investors parsed the latest read of employment in both the US and Canadian economies. The S&P 500 index closed lower by a mere 0.1%, pinning itself to declining trendline resistance that has been intact all year. That declining hurdle comes in around 4,070, providing a significant decision point for investors as they debate the long-term path of the benchmark. The benchmark remains above the declining 200-day moving average at weekend, a level that traditionally caps bear market rallies. The bulls and the bears certainly have much to debate this weekend. Support remains apparent around a confluence of major moving averages, 20, 100, and 150-day, just above horizontal support at 3,900, and short-term bullish setups continue to be seen, pointing to an upside target of 4,200. Momentum indicators are still pointing higher, but we can pick out some signs of exhaustion as the MACD histogram gravitates back to its middle line. Seasonal tendencies for stocks are soft between now and the middle of the month as tax loss selling/portfolio rebalancing pushes and pulls on stocks until the Santa Claus rally period commences in the back half of the month. Sentiment on Friday, as gauged by the put-call ratio, ended bullish at 0.84. Thanks for watching. If you like this video, please consider a like, share, and subscribe. See you in next video.